Hello everyone, welcome to the Life Wonder channel. Let's together explore the wonderful ideas in life. Today, I am going to show you the performance of ETF and different stock sectors. Hopefully at the end of the video, you can find an ETF to invest, which gives about 15 to 20% annual returns with relatively low risk. Let's begin the journey. What is ETF? ETF, the Exchange Traded Fund, is an investment fund which traded on stock exchanges. Basically, it is like a stock during trading. However, the price behavior is much like a weighted average of multiple stocks and bonds. One interesting ETF is the index ETF, whose price roughly follows a particular index of the market. For example, the SPY ETF tracks the S&P 500 index. You can view SPY as the collection of 500 stocks with different weights, where the large firms like Apple, Amazon, Google, Facebook, GE, have relatively high weights.
One of the greatest investors, Warren Buffett, once said, "For most people, the best investment is to own one index fund." Why? The very first reason is that it gives relatively stable, decent returns without excessive efforts. For instance, SPY has an annual return around 9%. You can just buy and hold it, and let it grow with time, without worrying it may bankrupt and vanish tomorrow. In contrast, if trading stocks, you really need to do a lot of study in order to beat this average index returns. The second reason to buy index ETF is the easy operation. You can buy and sell the ETF like trading the stocks. Plus, the management costs for the index ETF is really low compared with other mutual fund. S&P divides the stock market into 11 sectors. Almost every stock in the SP 500 can be categorized into one of the sectors. Correspondingly, there are ETFs that are designed to track the index of each sector. For example, XLK is the technology sector. The top holdings of XLK include companies like Microsoft, Apple, Visa, Intel. XLY tracks the index of the consumer discretionary sector. Consumer discretionary are goods and services that are considered non-essential by consumers, but desirable if their available income is sufficient to purchase them. The big companies in this sector are Amazon, Home Depot, McDonald's, and Nike. Similarly, we also have XLP, which is the ETF of consumer staples. Consumer staples are defined as essential products that include typical products such as foods and beverage, household goods, hygiene products, even alcohol, and tobacco. The other sectors include XLV, the healthcare sector, XLU, utilities sector, XLI, industrial sector, XLRE, real estate sector, XLC, communication services sector, XLF, financial sector, XLB, materials sector, and the last but not least, XLE, the energy sector. Different sector performance is different. We often use the SPY, the gold shares GLD, as well as the treasury bonds to benchmark their performance. In the following, let's take a look at the sector performance over the recent 15 years, from 2005 to 2020. Among the 11 sectors, only 3 of them shows better average annual returns than the SPY. The 3 sectors are the technology sector XLK, the consumer discretionary sector XLY, and the healthcare sector XLV. Let's have a check again on the price movements of these 3 ETFs for the past 15 years. Here we cite a chart that shows the 1-month return, 3-month returns, 6-month returns, 1-year, 3-year, 5 and 10-year average annual returns of all sector ETF. Again, the return of XLK, XLY, and XLV surpassed that of the SPY. For example, the 5-year return of XLK reaches to around 20%, roughly twice of the SPY return, and 5 times of the return from the 20 years Treasury bonds.
In fact, XLK, XLV and XLY also show huge resilience. In the recent sell-off caused by coronavirus panic, XLV, XLY and XLK all show relatively small drop compared with other sectors. Also from the high point on February 2nd to today, these 3 ETF pretty much recovers, while the other sectors, such as finance and energy, are still struggling.
So this is about the end of the video. We want to say that the purpose of this video is not asking viewers to buy any of the ETFs. Instead, we just want to use actual data to show some interesting facts and motivate people to think critically. Remember, there is always risk in investment. It is better to study first, think first, then take action if feeling comfortable. Thank you for watching this video. This is Life Wonder, and hope you have a wonderful life.